If you've been around crypto long enough, you know the pain September brings. The trench warriors don't call it Rektember for nothing. Historically, it's been smart to move into stables before the cursed month hits. But what if this year the late summer sell-off is actually setting the stage for a historic altcoin season? Today, we'll dig deep into the data, look at liquidity flows, and decode upcoming policy shifts to see what's really on the cards for crypto over the next few months. Will the TGA rebuild, drain liquidity, and bleed crypto out, or will a July rate cut finally send our bags flying? As always, we'll analyze both scenarios with a clear head and build our thesis based on data, not hopium. Stick around till the end because I'll also share my exact plan for playing the possible September dump. If you value rare, data-backed insights that the crowd usually ignores, make sure to tap that like button. It helps the channel reach more serious traders like you and keeps us motivated to bring you top-tier research. And of course, hit subscribe if you haven't already. Alright, first let's dig into how Bitcoin and the overall market have performed in September historically, and then we'll break down what causes these dumps. Since 2013, Bitcoin has lost nearly 5% on average every September, with 8 out of 12 Septembers closing red. That's exactly why traders call it Rektember and brace for late summer pain. Interestingly, all three post-halving Septembers have been red so far. But if you look at July and August, they've generally been green, which lines up with the current price action and the possibility of this rally stretching into August. While Bitcoin typically sees a 5% drop in September, altcoins tend to bleed far more. Even a heavyweight like ETH hasn't been spared, with its September monthly returns looking brutal. During post-halving years in particular, ETH has averaged a steep 15% drop. The silver lining is that much like Bitcoin, ETH has historically performed well in July and August. Now let's look at how altcoin market cap has behaved during post-halving Septembers. In 2021, altcoins rallied strongly through July and August, surging by 130%. But come September, they topped out at the 1 trillion mark and then crashed 30% back down to 700 billion. The 2017 cycle was even crazier since altcoins were still a much smaller asset class back then. Altcoin market cap exploded 275% in July and August, only to get cut nearly in half by September. That was a brutal correction across the board. Even ETH got cut in half from $400 to $200. History isn't destiny, but probabilities always matter when you're planning your entries and exits. Now that we've seen the brutal stats, let's unpack why September hits crypto so hard every cycle. One of the biggest drivers is seasonality. Historically, September has been the worst month for risk assets. Stocks tend to dip as fund managers return from summer breaks, lock in gains or tax losses, and rebalance portfolios ahead of the final quarter. Crypto, being a high beta asset, usually follows the same path. Another factor is end-of-fiscal-year behavior. Mutual funds and big institutions often sell their winners to lock in profits and meet reporting deadlines, adding even more downward pressure on the markets. Regulatory pressure also plays its part. September often sees a spike in SEC enforcement actions as legal teams wrap up their seasonal workload, which spooks investors further. Lastly, there's pure market psychology. Traders expect a Rektember dump, so many preemptively sell, which then triggers wider declines. In short, a mix of traditional market cycles, institutional rebalancing, regulatory seasonality, and collective bearish sentiment usually turns September into a painful month for crypto. But it's not just general seasonality at play this year. There's a major macro factor that could trigger a September dump in crypto. It is the Treasury General Account, or TGA. Think of the TGA as the U.S. government's massive checking account at the Federal Reserve. It's where tax revenue and money from selling Treasury securities gets parked. It is used to pay for things like Social Security, government salaries, and other federal expenses. When the Treasury rebuilds this account, it sells short-term bills to pull cash out of bank reserves and money market funds. On July 8, the Treasury announced it plans to rebuild its cash balance to around $500 billion by the end of July through regular bill auctions, without tapping into cash management bills. After that, they're aiming for their long-term policy level of roughly $850 billion in September. That means a modest liquidity drain during July and August, followed by a much bigger withdrawal of about $350 billion in early September as the balance moves from $500 billion to $850 billion. For crypto, this matters a lot. Every dollar the Treasury pulls out is a dollar less available for trading desks, hedge funds, and market makers. As bank reserves and money market balances shrink, margin financing costs rise and buying power for risk assets like crypto falls. Tight liquidity usually leads to price dumps across the board. The good news is that once the Treasury finishes rebuilding the TGA around September, liquidity starts flowing back into the system. That fresh funding often fuels a strong rebound in Bitcoin, with altcoins seeing even bigger gains. Keep a close eye on this TGA rebuild. It could be one of the key drivers shaping crypto price action in the coming months. The liquidity boost could get even stronger if the Federal Reserve goes ahead with a rate cut in September. Right now, the FedWatch tool shows a 58% chance of a cut on September 17, while a cut on July 30 is nearly off the table with just a 5% probability. For crypto markets, lower rates would be a major tailwind, especially at this stage where institutional adoption is growing rapidly. There is a mountain of institutional capital sitting idle, waiting for the right macro setup to deploy. Large financial institutions and hedge funds typically move in sync with traditional market signals. When the Fed cuts rates, these players often rotate capital into higher-risk assets like crypto, treating it as part of their broader risk-on allocation strategy. This inflow could act as a powerful catalyst, driving momentum across the entire crypto market. Combine that with the Treasury finishing its cash rebuild, and suddenly banks, hedge funds, and trading desks are sitting on fresh capital with lower borrowing costs. Historically, this environment has been the perfect setup for what traders call an October rally. Over the past 9 years, October has delivered average gains of more than 20%. During these rallies, altcoins have consistently outperformed Bitcoin, with mid-cap alts often pulling off 4 to 5x moves from their September bottoms. If history rhymes, this could set the stage for one of the most explosive phases in the current cycle. Here is how I'm personally getting ready for a potential September dump. I plan to use this current rally to trim some of my altcoin positions, applying top hunting strategies I've shared in earlier videos and detailed threads on X. Make sure you're following me there, since I post real-time updates on my moves along with regular market analysis. The most probable scenario is that July turns out strong for altcoins, as history shows. But don't get fooled thinking the pumps are just getting started. I'm already noticing signs of peakish sentiment. YouTube comments are filling up with questions from newbies, and search interest in altcoins has spiked. That tells us retail is entering aggressively. We've also seen dinosaur coins and NFT projects pumping. These are classic signs of a heated market. You could argue we're still early in this move, but there's no harm in locking in partial gains if your bags are up. It might rub some people the wrong way, but I trade based on data, not emotions. I'm just here to share the reality, whether it's pretty or not. This bullish momentum might continue into early August and could peak towards the end of the month if Bitcoin hits a local top. By that time, most of the catalysts I've discussed will have played out, and I want to have dry powder ready by banking some altcoin profits. If history repeats, we'll likely see a September dip where many alts give back a big chunk of their gains, just like they did in March and December 2024. At that point, I'll be looking for accumulation zones on the dips, areas where price finds strong support and liquidity starts coming back in. Keep in mind, I won't be selling a large chunk of my altcoins. A part of my portfolio is always allocated to short-term trades, and I also have some deadweight alts that I plan to cut loose. If you're a long-term investor who never sells, then see September weakness as a chance to dollar-cost average and build your core positions at discounted levels. Also remember, sound risk management is everything. Set stop losses below key supports and size your trades so no single position can wipe out your portfolio. To wrap it up, July and early August look set to pump our bags. Late August could bring some cooling off, and September is likely to bleed. But once October rolls in, liquidity should return, setting the stage for an alt season in Q4. Of course, this is just my read on the current data. No one can predict markets with certainty. What's your take on this? And how are you planning to navigate this year's Rektember? Drop your thoughts in the comments below and make sure to subscribe so you don't miss our next deep dive. Thanks for watching, and I'll see you in the next one.